Okay, let's go ahead and get started. I'm going to introduce Cindy and she'll start us off.
Let me unmute. Good evening, everyone. My name is Cindy Esquivel. I am one of the program managers here at LIIF. We are working in collaboration with the Department of Social Services. Just a little bit about who LIIF is. We are a low-income investment fund who's been leading the community development financial institution since 1984. And we're deeply committed to supporting and uplifting communities of need across the United States. We have some offices in New York, San Francisco, Washington, D.C., and Atlanta. And I am super excited that we get to have Civitas here today. I will pass it on to Marlene so she can take over and give us some tax knowledge.
Great. Thank you very much, Cindy. I'm going to go ahead and share my screen for you. Let's open that up there. Always a process sharing screens. Thank you so much for having us tonight. Appreciate you having us to talk about these very important the information that we're going to share tonight about your taxes. So let me make sure that I have everything set up the way it needs to be. Perfect, perfect. All right. So tonight in this presentation, we will share a process using a limited amount of information so that you can gauge your taxes and go through options that you have that you can help mitigate, or that will help to mitigate your tax bill before the end of the year. Now, before we begin, I'd like to provide a disclaimer. The information contained here has been prepared by Civitas Strategies and is not intended to constitute legal, tax, or financial advice. The Civitas Strategies team has used reasonable efforts in collecting, preparing, and providing this information, but does not guarantee its accuracy, completeness, adequacy, or currency. The publication and distribution of this information is not intended to create, and receipt does not constitute an attorney-client or any other advisory relationship. Reproduction of this information and recording of this content, including the use of AI, are expressly prohibited. Only non-commercial uses of this work are permitted. All right. So welcome everyone. And like I said, in today's session, we will be covering several important tax topics to help you run your childcare business smoothly year round, not just during tax season. So first, we will discuss why you should care about your taxes throughout the year and not just on April 15th. Next, we will explain basically what the Schedule C is and how to use it to report your childcare business's income and expenses. We'll also go over some steps that you should take now to basically get organized and prepare for the tax filing for next year. And finally, we'll share tips to proactively mitigate your tax burdens through deductions, contributions, retirement plans, and more. So our goal today is to provide you with tax knowledge to optimize your filings and minimize headaches when tax season rolls around again. Now, I do want to remind everyone that we will have a Q&A towards the end of the presentation. So you are welcome to jot your questions down and share with those in the room who are taking those questions through Q&A. But I will address questions when we reach the end of the presentation. All right. So knowing how to effectively address your taxes can help you with a couple of different things. Number one, it can help with profit retention. Now, while it is the responsibility of every business to pay their fair share of taxes, proper tax preparation, that can be a vehicle for recapturing your hard-earned profit and keeping more money in your pocket. So, understanding allowable expenses results in legitimately paying less taxes and retaining your profits. The second reason is risk mitigation. Now, education is key when it comes to understanding allowable expenses and properly preparing your taxes. The more that you are aware of the tax rules as they apply to childcare businesses, the less likely you are to trigger an audit. Audits are very time consuming. They can cause distress. And at the end of the process, it may prove to be very costly for you, as an audit will most likely result in you owing money that you're not prepared to pay. Now, the third reason is understanding your business health. Reviewing your taxes is a fantastic way for you to evaluate the health of your business. Having an accurate account of profit really allows you to understand the financial position your business is in, and it can help you to plan for changes going into the future. And then also, it can help you build business confidence. Uh, we all know that knowledge is key. So, having confidence and knowing that you have properly claimed deductions and have met your tax obligation, it removes the factor of the unknown. So, understanding taxes gives you the ability to continue to operate with the mindset that you are following the rules that are set by the IRS and are unlikely to have unforeseen debt or even the potential future problems like an IRS audit. Well, through our years of hands-on experience supporting childcare providers with tax-related challenges, we recognized the need to identify key areas where businesses could improve their tax filing practices. So to ensure our guidance to ensure our guidance would be truly valuable, we did conduct a comprehensive analysis of childcare business tax returns. Now, this research helped us to pinpoint specific opportunities where providers could enhance their tax preparation strategies and basically maximize their benefits. Now, our research on past taxes illuminated several findings that we have tracked while working with these childcare businesses and the businesses that we work with every day. So, first, a striking 83% of home based childcare providers did not claim the business use of home on their Schedule C, which is line 30. Now, as a home based provider, you can deduct expenses shared between your business and personal use of your home, and that's a significant missed opportunity for tax savings. So these deductions can include portions of your utilities, your mortgage interest, property taxes, and maintenance costs that relate to your business operations. We also discovered cases where providers reported no expenses at all on their tax returns. Now, this is concerning since every single childcare operation inherently incurs deductible expenses. You're all going to have them. The Schedule C offers numerous expense categories, and understanding these can help you to reduce your tax liability while preserving more profit for your business. Now, from educational suppliers to toys to cleaning materials and professional development costs, these expenses are essential to document and to claim. Now, some providers claimed inappropriate business expenses, significantly increasing their risk for an audit. Now, remember that deductible expenses must be both ordinary and necessary. And you'll hear me say that a couple of times because that's an IRS term, ordinary and necessary. And your expenses have to be ordinary and necessary for your childcare business. Now, the IRS has specific expectations for what constitutes valid expenses in a childcare. And deviations from these norms can trigger additional scrutiny on your business. So it is important to maintain clear documentation and ensure that each expense directly relates to your childcare operations. Also, common deductions were frequently miscategorized or incorrectly calculated, and that is also a potential trigger uh, for a red flag, if you will, for an IRS audit. Now, here's an example. Many providers mistakenly list children's meals under the Schedule C business meal deduction line, which is actually intended for travel related business meals. Now, even when the expense itself is legitimate, improper categorization can lead to unwanted IRS attention. Now, understanding the correct classification of expenses is just as important as identifying deductible items. So, these findings underscore the importance of understanding proper tax preparation practices specific to the childcare industry. Accurate documentation and proper categorization of expenses can definitely help you maximize those legitimate deductions while avoiding any unnecessary audit risk. All right. See a lot of activity in the chat. Keep in mind, we will address your questions towards the end. All right, so just go ahead and jot those down and we'll get to those when we get there. So while there are various tax forms that you'll encounter as a business owner, we want to focus on the Schedule C. This is a crucial document for reporting business income and expenses. So even if you work with a tax professional, understanding these basics will definitely help you make some more informed decisions for your business. Now, the Schedule C is used to report income from sole proprietorship as it's part of your personal 1040 tax return. Single member LLCs or limited liability companies that have not elected to be treated as a corporation, they can also use this form. However, if your LLC has chosen to file as an S Corp or a C Corp, your business income won't be reported on your personal return. And that's a whole different thing. But tonight we're focusing on the Schedule C. So, important note, if you're operating multiple unrelated businesses, you're definitely going to need to file separate Schedule C forms for each business. Now, I'll give you a perfect example. Let's say you're running a craft business on Etsy and you're also driving for a popular rideshare service. This would require two distinct Schedule C forms as those businesses are not directly related. Now, the basic structure of the Schedule C follows a straightforward logic. First, you're going to report all of your revenue. Now, this is all of the income that you received from your business operations. Next, you're going to list all your business expenses. These are costs that are necessary to run your business. And then finally, you're going to calculate the difference between the revenue and expenses. Now, positive number generally indicates that you made a profit, while a negative number will more than likely show a loss. Now, this calculation provides a clear picture of your business's financial performance for that particular tax year. Now, understanding how to properly categorize and report your income and your expenses on the Schedule C is critical for making sure that you have accurate tax filings and maintaining uh, good business records. So we're going to take a look at the Schedule C, and it's broken down in a couple of parts. So let's take a closer look at it to view the different sections for reporting data on your business. So if you use tax software, it will enter these numbers based on the answers to certain questions that you may have, but it can still be very helpful for you to know your way around this very important document. So knowledge is key when it comes to your business taxes. Even if someone else is preparing your taxes for you, you're definitely going to want to understand this, the Schedule C. So in part one, this is where your sales are totaled and your cost of goods sold is reported so that you can see your gross profit. Now, just a quick mention about cost of goods sold on your taxes. They also refer to this as COGS, COGS or COGS, but cost of goods sold refers to the cost for sales of products rather than services. So it's very, very rare that childcare businesses will have an entry under cost of goods sold. So if you have something in that category, we normally will look at that as, or really scrutinize that. And I believe the IRS will scrutinize that too, as childcare providers usually do not have anything in that category. Now, part two is where your business expenses are reported. Now, this is the area of your Schedule C where you will want to be very acquainted with. There are over a dozen categories listed to help you stay organized. Things such as advertising, car and truck expenses, legal and professional services, rent, travel, meals, and a host of other costs. So those allowable expenses are what reduce your profit, thereby reducing your tax liability. So, accurately including all of your allowable expenses is key when filling out your Schedule C. And then the last section is where your net profit is calculated. Typically, that you're going to find that on line 31, and you'll just find that by subtracting your total expenses, which comes from part two, and subtract that from your total revenue in part one. And your net profit is considered your income from your self-employment. Right. Now, let's just switch gears a little bit and discuss how you can proactively prepare for tax season. Try to avoid some headaches down the road, as proper preparation is going to be key to helping you tackle tax time like a pro. So this is a very, very valuable resource, and we want to highlight this for tax preparation. But this workbook from Playground, it aims to help home-based childcare providers optimize tax preparation process and maximize deductions. It covers a host of topics. I think it's an amazing resource. Um, it covers record keeping, best practices that you can implement now, such as tackling income, expenses, mileage, and the business use of home. It also helps you to understand the Schedule C and where to capture your income and different types of business expenses, how the business use of home deduction works, including calculating and documenting your time space percentage. And we will cover time space percentage a little bit tonight. And then it also talks about how you can maximize your write-offs with eligible deductions for supplies, meals, utilities, repair, insurance, and so much more. It also has tracking and claiming resources and tools for automobile mileage, business travel, um, covers depreciating assets like equipment furnishings over time, and choosing the right business structure that's so important, such as learning the difference between an LLC versus the sole proprietorship. Um, it also talks about some proactive tax planning steps that you can take this year that will help you to maximize next year's returns. Now, this workbook includes checklists, guides, and visual examples that will basically walk you through every step to support your home-based childcare in preparing for tax season by providing actionable steps that you can take and implement right now so that you can make tax time easier and basically save money. I think this is a wonderful resource. I believe we have dropped a link for that in the chat, if I'm not mistaken. Yes. Definitely encourage you to go through that workbook. It is a very valuable resource. And we're going to reference a lot of information from there this evening. All right. So when it comes to understanding your taxes, you'll find that it's all about what you made and what you spent. And share why that is. So the first section of your taxes is all about revenue. That is how much money you made. So getting this information may be very easy if you have accounting or childcare management system. But if you do not, no worries. You can also use the revenue worksheet that we have dropped the link there for you, and you can use that to calculate it. So start by gathering your records. That's the first step. You are likely to have three types of records for revenue. The first is going to be 1099 forms. Now, these are evidence that another business paid you for services. Now, many home-based childcare providers will receive a 1099 for subsidy care payments and for participation in the food program or CACFP. Now, throughout last year, you may have heard that if you received $600 or more in payments through payment app like Venmo, you would receive a 1099K or something like that for that tax year. In November, the IRS decided not to enact that rule. So for 2023, you would only receive a 1099K from payment apps if you received a payment that exceeded $20,000 and had more than 200 transactions within that year. Now, in 2024, that threshold changed a bit to payments exceeding $5,000. So we do recommend that in the coming year, you listen for any announcements to see if the threshold changes for 2025. But we really don't have any way of knowing if that will be the case. So having said that, you do need to report all of your income that you have received via payment apps as income, even if you don't receive that 1099. You'll want to add up all those amounts that you've received throughout the year for revenue. So that's number one, they're 1099 forms. The second is going to be your bank records. This is showing additional funds that you may have received from other sources. Now, your own documents, such as year in or weekly receipts that show payments or that you paid for care is going to be the third source. Okay. So you have 1099s, your bank records, and other documents that you may have on hand. The next step is to basically fill out the worksheet. Now, this is going to, here you're going to want to make sure that you include each 1099 and revenue for each child that you serve. You're going to also want to list other sources of income, such as grants that you may have received, but that you may not already have accounted for on a 1099. So be careful not to document it twice. Just want to make sure that you're accounting for all of your income. Now, if you received reimbursement for food costs through the food program, you can report all of your reimbursements under the income section in Part 1 of the Schedule C, using that 1099 that you received. Keep in mind, you can then deduct your food expenses in full, just putting it into the expense section. So you claim it in Part 1, and then you can deduct it in Part 2. All right. So once you have your business income, you're definitely going to need to collect those expenses. This is going to be what you have spent money on for your business in the year. So make sure that you have records of your cost, ideally receipts showing payments for the expenses, but you can also, in most cases, use canceled checks, invoices, or credit card and bank statements. But it is critical that any proof of expense show the following. Number one, that you paid the expense. Number two, the amount that you paid. Number three, the date that you paid it. And number four, a description of the item that was purchased or the services that were received. Now, the mileage log that is included as a resource, and we also will share that information as well. This is a simple log that you can use to fill in your vehicle use information. Keep in mind, hopefully you are able to go through and look at all of those resources as we're going through. And then we are dropping links in the chat for you so that you can reference those as well. So to collect your expenses, you will want to start by collecting all of your receipts. The next step is to go month by month in your records for the previous year to review your credit card bills, check the app-based system payments that you may have received, such as Venmo, Zelle, PayPal, Square Cash, or other app-based systems. And then you're going to want to look at your bank statements and your checks. Now, with your accumulated expenses, you can now fill out the digital expense worksheet, which is also included. Now, the worksheet uses expense categories from the Schedule C that are really most relevant to home-based childcare businesses, but they can also be used for any corporate or partnership tax returns as well. Now, the full amount of home expenses that are directly related to your business can be included in your expenses in the table that you see. The IRS defines a direct expense is one that is incurred exclusively for the business and provides no personal benefit. That is a direct expense. I'm going to read that one more time. The IRS defines a direct expense as one that is incurred exclusively for your business and provides no personal benefit. So some examples of direct expenses in your home are like if you were fixing bathroom used only by the children in your childcare, or maybe getting a new children's rug for the play area, and maybe even playground equipment that is exclusively used for them. Now, indirect costs associated with your home, such as your homeowner's insurance or maybe your electric cost, these will be covered in the following section, which covers your business use of home. And we'll also talk about the time space percentage and how you calculate that. So you should keep all of your pay stubs during tax season and at least 4 years afterwards. It's great to have both paper and electronic copies, even if it's something as simple as taking a picture of it on your phone. Having duplicate copies is going to be the most beneficial for you. So please make sure that you are doing that. All right, now I want to go over a few categories that are often considered to be tricky topics. All right, we're going to start with the vehicles. Now, as with all deductions, there are some very specific rules and guidelines that you will definitely want to follow. Now, here are all the elements that you need to make sure that your transportation is deductible. It must be in the regular course of doing your business, and it must be related directly to childcare, like if you're picking up the children, or it also must be business related, such as making a milk run to go to Costco. Now, you always need to keep your personal and your business travel separate. And we have a couple of tools that will help you to be able to do that. Now, when it comes to business trips, the primary rule is that the trip can be both for personal and business purposes, but it is only deductible if the primary purpose of the trip was for business. I want to give you a couple of examples. Let's say you go to Costco. You want to purchase a long list of supplies that you have for your childcare center. But in the meantime, you actually pick up a personal item like maybe a jar of pickles. The trip would still be deductible since supplying your business was the main reason for the trip in the first place, because you went to purchase a list of supplies for the children. Now, on the other hand, if you went to the grocery store to pick up your own groceries and you just so happen to pick up an item or two that you need for your childcare center, then that trip would not be deductible since your personal errands were the primary focus. Make sense? So the key is looking at why the trip was necessary in the first place. Now, if the main purpose was business, it can be a deductible trip, even if you happen to pick up some personal items along the way. But if the priority was for personal reasons, with just maybe an incidental business purchase, then it would not qualify as a business expense. Very important to remember that. All right. So if you use your vehicle to conduct business for your childcare, you may be wondering how you can deduct your transportation costs. And there are two ways that you can deduct your vehicle expenses. The first is the standard mileage, and the second is the actual expense method. So we'll talk about these here. So first, the actual expense method, it captures all of your costs that are associated with your vehicle, but it does require some extensive documentation, including keeping every receipt and logging mileage for both your personal and your business use. Now, there are pros and cons associated. The pros of this method are that it might result in a higher deduction, especially if your vehicle is used extensively for work. However, the cons are that it may take a significant amount of time to collect and retain all of your receipts and mileage logs. Now, while the actual expense method can provide a larger write off, it also demands some careful record keeping, making sure that you're tracking both your business and personal use, as well as proof of payment for all of your vehicle costs. Okay, but that's just one method. Now, Alternatively, you can track all of your all of your actual expenses. You can use the IRS standard mileage rate, which basically simplifies the deduction tracking, but it still requires a detailed log of your business miles that are driven. We have dropped a link for you in the chat there. Now, the pros of the standard mileage are ease of calculation and fewer records to collect, as you only really need to track your business miles and not necessarily your personal miles. However, the cons are that the deduction is limited to a fixed rate, which is set by the IRS, and your records may have greater scrutiny through this. Now, regardless if you choose the actual expense method or the standard mileage, you still need to log. You still are going to need a log noting the dates, the distance that you traveled, the location, and the purpose for each trip, specifying whether it is business or personal. Now, while the standard mileage reduces the documentation burden, you still have to carefully track mileage in a log along with your trip details so that you can justify the deduction. And so we do encourage you to compare the effort that is needed for each method when you are deciding which one is going to work best for you and your taxes. All right, now moving on to food. The basics for deduction for food and meals are that food is fully deductible with two exceptions. And the big question is how to do it. So, children in your care are fully deductible, and you can report the cost in multiple ways. For staff, only 50% is deductible. For your own children, those costs are not. Okay. Now, there are two methods that you can use to deduct your food cost. Again, there is the actual expense method and the standard meal rate, which we will give you some more information on here, as well as pros and cons. So you can deduct as a business expense 100% of the actual cost of food that is consumed by the daycare children, and generally only 50% of the costs that are consumed by your employees. However, you can deduct 100% of the cost that is consumed by your employees if the value can be excluded from their wages as a de minimis fringe benefit. I'm going to say that again, a de minimis fringe benefit. And these are basically benefits that you can give your employees that are lower in value and excludable from an employee's taxable income. Now, to simplify the record keeping requirements, there is an optional standard meal and snack rate that family childcare providers may use while computing their deductible costs for food provided to those eligible children in the daycare in lieu of the actual cost. How is this done? Well, we do that by keeping track of the meal types, the number of meals provided, and simply multiplying it by a set amount. Now, there's pros and cons, like I mentioned earlier. Pros are that there's easier record keeping with this method. You can still deduct some non reimbursed meals, and that's one of the biggest pros. Now, the cons will be that you still need to keep the names of each eligible child, the dates, the hours of attendance, and the number and types of meals that are served. But that's typical with anyone claiming expenses through the food program. Now, here is a note. The Child and Adult Care Food Program, or CACFP reimbursement rates, these can be used by home-based childcare providers to basically simplify the calculation of food cost, regardless of whether they're participating in the food program or not. We have dropped a link to the reimbursement rates in the chat for you. But the rate is based on tiers. So we have tier one rate that's under CSCFP, and the provider can use the standard meal and snack rate for a maximum of one breakfast, one lunch, one dinner, and 3 snacks per eligible child. Yes, I said that correctly. This is different from and varies from that CACFP reimbursement rate where it's usually 2 meals and a snacks or 2 snacks and a meal, right? In this, you can, again, I'm going to say, you can use the standard meal and snack rate for a maximum of one breakfast, one lunch, one dinner, and 3 snacks per eligible child. Okay. I'm sure I'm going to get questions about that, but just hold those to the end. But yes, this is something that the IRS allows in addition to what you're doing through the CACFP. It's a little bit different, but you can claim more meals that way. So that's a perk of that. And it's only for our home-based childcare providers. Now, to figure out how much of your expenses are considered business expenses, because we've moved on to our home now. I'm sorry, need to make that transition. To consider how much of your expenses are considered business expenses and what percentage of those expenses can be deducted on your federal income taxes, our family childcare providers will use what we've referenced a couple of times tonight, and that's the time space calculation. Now, in time space, you're going to classify your space as either regular use or exclusive use. So let's look at the definitions for both regular and exclusive. When we talk about regular use, these are areas that are used all day, such as play area, or even areas that are used part of the day, such as maybe napping areas, but they may have other uses during non-business hours, like if you're sharing those spaces with your family. Now, exclusive use, on the other hand, are those areas only used, only used for your child care program and nothing else. Thus the word exclusive. Okay. Now, we are going to look at a few examples here, so to help you kind of see this from a different light, make sure that we get a clear understanding of the difference between regular and exclusive use. Now, exclusive use would be having a separate basement entrance that is only used by families of your childcare business, or maybe even a storage room that only contains toys and supplies for your business. Now, on the other hand, regular use would be using maybe your bedroom daily for nap time, or for the children using your living room every day, or maybe once a week for STEM activities. So exclusive use space can be fully deducted based on the percentage of the total home square footage that you have, since it is 100% for your business. Regular use space, on the other hand, is deductible based on the percentage of time that is used for your business rather than your personal needs. So properly documenting both types of usage is going to be key in justifying any home office deduction that you take. All right, so home cost, they can be fully or partially deductible, and that's going to depend on the nature of the expense. Now, cost for exclusive use areas or direct business costs are likely to be fully deductible, like we mentioned before. Now, example again, replacing maybe a tile on the basement floor that is only used for the childcare, or installing maybe a child-sized toilet, or even your liability insurance, because that is only an expense that you would incur for your business and your business alone. And so these would be fully deductible. Now, expenses for regular use spaces or common improvement areas, those are only partially deductible, and they're going to be based on your business use percentage. Now, examples would be replacing all of the windows in your home. Of course, that's not only for your business, you share that with your home, right? So, repaving your driveway, of course, that is a shared area, so it would not be 100% deductible. Or even your home insurance. You're going to have, if you are a homeowner, you're going to have to pay for homeowners or renters insurance regardless. So those are going to, even though they're impacting the property, it is something that you are going to share the expense. So in regularly used areas, you need to use the time space calculation so that you can determine how much of these spaces can be deducted. And we already have referenced the time space calculation, so we will talk more in depth about that in just a minute. The key is to identify whether a cost directly supports the business, it benefits, or if it benefits that shared spaces that you have, or is it's a general home improvement, so that you can determine if it's fully, partially, or even non-deductible. Okay. Now remember that in time space, you are going to classify your space as either regular use or exclusive use. Now, the time portion of time space calculation is going to weigh how much time those regular areas are used for business. Exclusively used spaces are going to be weighted at 100%, like we said, because there are no other uses for those spaces, whereas those regularly used spaces are going to be weighed at the portion of time that you have used your home for business purposes. So you can determine the time space calculation using 6 easy steps, which we have here on the board. Step one is going to be to determine the square footage of your regular use space. Step two is to divide that number that you get by the home's square footage. Step three will be to then determine the amount of time that your home is used for childcare. In step four, we're going to divide the hours by 8,760, which is basically the total number of hours in a year. In step five, we're going to multiply the time space percentage, and we'll walk through these steps in just a second. In step six, we're going to divide the exclusive use space by the total square footage of the home, and then add it to the results that you got from step five. So using these steps, you can easily determine how much of your home expenses can be reimbursed or deducted from your federal income taxes. Now, here's an example that you can attempt to calculate on your own using the steps from the previous slide. Try to see if you can determine what this provider's time space percentage would be. Excuse me. I'll give you some time to look over some of the details, and then we'll discuss it kind of together. But on this side, we have a business. Their home is 1,500 square feet. 500 square feet are exclusive. 700 are regular. She is open 10 hours a day, but she spends an hour before and an hour after doing prep and cleanup. And then she's closed 2 weeks out of the year for vacation. And we know that there are 52 weeks in a year. So that tells us that she's open for 50 weeks. So let's look at this example in more detail and walk it through step by step. First, to determine the square footage of the regular spaces. In this case, we already know that the total square footage of the home is 1,500 square feet, and 700 of those are regular. But if you were to do this, you would simply take this simple formula, length times width is going to equal square footage. So to find the square footage of oddly shaped spaces, such as if you have like a room with a nook or it's filled by a closet, it's easy to figure out these spaces. You're still going to do the length times the width, but you're going to just break that room into smaller rectangular blocks, and then use the square footage calculation for each of those blocks and simply add them together at the end once you get your numbers. Then we're going to move on to step 2, which is basically dividing the square footage of the regularly used childcare space by the square footage of the home to determine a percentage. Now, we were already given that 700 is regular use, so we're going to divide 700 by 1,500 total square feet of the home, and it's going to give us a decimal point, which we think can basically round up to 46.7%. Now, the square footage, and this is very important, so I'm going to say this twice so that you get this. Square footage for outdoor areas cannot be included in your time space calculation. However, external spaces that are physically attached to your home and regularly used for childcare, this includes spaces like a deck, those can be included in your space calculation. The operative word there is physically attached. It has to be attached. It cannot be a detached structure, okay? And it has to be used for business as well. Now, step 3 is to determine the amount of time that the home is used for childcare during the year. So to do this, we are going to calculate how many hours the childcare space is open per week, including the time that is spent preparing and cleaning up when the children are not present. Yes, you can count that time. So then we're going to multiply that number that we come up with by the number of weeks that they were open for services, and then add any work hours that were performed while you were closed. So in this particular scenario, we were given that this person was open 10 hours per day, and she did an hour of prep and an hour of cleanup. So if we add all of that together, it's going to give us a total of 12 hours that she used. We're then going to take that 12 hours per day, multiply it by 5 days a week, because most of us work 5 days a week. And remember, I said that she closed 2 weeks out of the year. So that told us that she was open for 50 weeks. We're going to multiply that then by that number as well, and we'll come up with the total hours of 3,000. Now, moving on to step 4, we're going to divide the hours that the home was used for care by that number that we gave you that was for the total hours in a year. So we're going to simply take our 3,000 used for care divided by 8,760. It will give us a decimal point. We can then convert to 34.2%. In step 5, we're simply going to multiply the time space percentages. We do this by taking the square footage percentage that we got, which was 46.7, and the hours per year percentage that we just calculated, which was 34.2. You are going to need to convert those back into a decimal point, multiply them together. It's going to give you another decimal point, and you can just simply say it's 15.97%. Now you can round it up, but most people keep it the same. So it's up to you. Then step 6, we're going to divide the exclusive use spaces by the total square footage of the home, and then add it to the results that we got in step 5. So we know that here there are 500 square feet that were used exclusively for the childcare, because that was given to us. We also know that the home has 1,500 square feet, so we're simply going to take the 500 divided by 1,500. It will give us a decimal point. We're going to add our 16%, and it's basically going to give us another decimal, which we will then come up with 49.3%. So this provider, their allowable time space percentage deduction would be 49.3 of the allowable home expenses. I hope that all made sense to everyone. Going to keep on moving. So the general rule here is that when we talk about grant money, grant money received has to be reported as income. However, you can deduct any valid business expenses that are associated with the grant money in the same tax year. Now, timing of when that grant income is received versus when the expenses are incurred can impact your tax situation. So let's take a look at 3 different scenarios to see how that works. Now, here is a basic scenario. It's very straightforward. Your business received a $10,000 grant, which was reported in revenue, and spent that same $10,000 in the expenses in the same year. So in this case, nothing changes. You spent it in the same year that it was reported. Now, let's say that a business got the same 10,000, but only had $5,000 in expenses. So in this case, you're going to have to spend or pay taxes on the $5,000 difference. And in our third and final scenario, let's assume that the business got that same $10,000 grant, but as with some grants, you were able to attribute it to the spending that happened in the prior year. So in this case, this provider would have to pay taxes on all $10,000 because in 2024, they cannot claim that expense, but they do have to pay that tax on there. Okay. Now, in terms of California specific information, there are some things related to taxes that are unique to the state of California that are worth reviewing before we jump into tax preparation. So let's go over those and take a look at how your tax bills are calculated in California first regarding the estimated income taxes. For sole proprietors and partners, this is a recommended practice for federal taxes, but California small businesses should be aware that state income taxes are also not typically withheld. So if this applies to you, quarterly payments of estimated income taxes is crucial to avoid penalty. Now, if you don't have a recommendation from your tax software or your tax professional, we would recommend paying an estimated tax of 4% of your overall revenue. Okay, there's also a minimum franchise tax for LLCs and corporations in California. Now, these businesses are subject to a minimum franchise tax of $800, regardless of your income. This annual tax is structured as a flat fee, and it is due even if the business did not have a profit that year. So similar to other tax payments, familiar to pay with the minimum franchise tax on time can definitely lead to penalties. So you want to make sure that that is being taken care of. And on the flip side, through, well, even though it's like this likely doesn't apply to many people in the room, there are franchise tax rules that apply to those businesses with a profit over $250,000. So remember, this is not revenue. We're talking about profit. Rates can be found in the link that was dropped in the chat for you. And then finally, there is an additional rule for S corporations and C corporations. This is worth mentioning as well. There's also a 1.5% tax on revenue for S corporations and C corporations through the no franchise fee. Now, LLCs that are treated as S corps do not have to pay this tax. And we also have a link for that as well. I think it might be the same link. But if not, Carlos will drop that in the chat for you as well. Okay. Now, there is also a California wildfire tax relief for Los Angeles County. The IRS has announced a tax relief measure for individuals and businesses affected by the Los Angeles County wildfires. Now, anyone impacted by these wildfires will have until October 15th of this year to submit tax returns and make tax payments that were originally scheduled between January 7th of 2025 and October 15th of 2025. Now, this extended October 15th deadline encompasses several types of tax filings. These include individual income tax returns and quarterly estimated tax payments. The expansion also covers quarterly payroll and excise tax returns. Additionally, calendar year returns for various business entities will receive this extension, including those for partnerships, S corporations, C corporations, fiduciaries, and tax exempt organizations. Now, the IRS will provide additional guidance through official notices, specifically targeted to wildfire victims, which will be made available through the appropriate channels. Now, we are dropping several links in the chat for you in reference to these, the IRS newsletter, list of eligible locations, disaster assistance and emergency relief for individuals and business. All right, so those should all be in the chat for you to review. All right. So the tax year has ended. So what does that mean? Does that mean that you don't have any options for mitigating your taxes from last year? Well, let's talk about that. So if you're still looking for a way to mitigate your taxes from the previous year, you still have options, such as contributing to a retirement plan. Now, if you don't already have a retirement plan for your business, setting one up could provide some tax advantages. Contributions that are made to a retirement plan on behalf of the business owner and employees are typically tax deductible. So, as a small business owner, you can open up a SEP IRA for both you and your employees from January through April 15th and make contributions and receive your and you can reduce your previous year taxes. But you will want to discuss this option if you choose to go this route with a financial institution for more information on setting up a retirement account. So please always consult with a professional when opting to elect those options. Now, while you may not have options other than retirement plans to mitigate your taxes after December 31st, if you find yourself with higher taxable profits than you expected, it is the perfect time to use that money wisely. So considering the following actions to make best use of those extra funds is what we are going to suggest here. The first is to pay down your debt. Now, if your business has any debt, this could be a good opportunity to pay them down. This could save you money in the long run by reducing interest payments, which we all know accrue and make those final bills higher over time. A second option is that you could create a reserve fund. Having a financial cushion can definitely be a benefit for your business. If you have those higher profits and you have steady expenses, consider setting aside some of that money and some of that profit in a reserve fund that can cover future expenses and unexpected costs. Now, if you're wondering how much you should shoot for, if you're just getting started, we will typically say like 1 to 3 months. but a good target is going to be a 6-month or more cash reserve. The next option is to invest in business expansion. Now, with higher profits, you might consider investing in the growth of your business. This could involve hiring more staff, expanding your physical premises, maybe even launching new products or services, or even investing in marketing and advertising. Now, these investments could potentially lead to even higher revenue in the future, but note that these will also be allowable deductions in the next tax year. You could also set a time for a mid-year tax review and do that now. So many business owners do what we call a tax check-in. It's usually between August and October. Now, despite the fact that this is actually late summer to early fall, you will often this is referred to, like I said, that mid-year tax review. Now, this effort, it can be a very important one since it allows you to see where your tax liability is heading before you close for the next year. And you can also see where many opportunities are that may affect your tax liability at the end. So, additionally, you're going to want to conduct a review that can help you to understand your tax liability since you are required by law to pay at least 90% of your actual taxes for the current year or 100% of last year's taxes to avoid penalty. Now, I will say that again. By law, you are required to pay at least 90% of your actual taxes for the current year or 100% of last year's taxes to avoid penalties. Now, a tax review before the end of the year can help you to plan how much more you're going to need to pay in estimated taxes so that you can avoid paying even more penalties. Now, this review is going to involve checking your revenue, which is the money that you took in, and your expenses this year against last year, as well as any resulting profit. And that is your revenue less your expenses. Now, you'll also want to check how much you have paid in taxes so far. And this process can be as in depth as you choose, from just seeing if you're making more money to essentially preparing your own taxes. All right. So now we're going to move on to how you can get your taxes prepared. Here is just a brief pros and cons list comparing paid tax preparers versus self preparation to help you decide what method might work best for you and your business. So, for paid preparers, when you're searching for a tax preparer, you want to look for someone who has been either recommended by people in your network or people that you know have worked with childcare in the past. Now, additionally, it is beneficial if they do have specific childcare expertise, particularly with businesses just like yours, if that is possible. I like to call that comparing apples to apples. You can look for a provider that has done childcare taxes before, but if they do taxes for nonprofit childcares or larger corporations, you really want to see if you can find someone who knows how to do the taxes for your type of business. So if you are a home-based childcare provider, you want to find someone who has that experience, preferably. Now, we know that's not always possible. Now, there are pros and cons associated with that. The pros is that you will have a guide along the way, which we will talk about here in a bit. The cons is that it can be expensive to do that or more expensive than self-preparation. Now, self-preparation is often more cost-effective and efficient for most providers. Additionally, the IRS tends to audit online computer-generated tax returns less frequently, as they generally find these to be more accurate and beneficial for the taxpayer. Now, again, pros and cons of these. Pros would be that the calculations can be more accurate and it can be less expensive. The cons would be that the guides are going to be an additional cost. Now, regardless if you decide to take everything on take everything to a professional tax preparer or utilize those additional resources and tools so that you complete your taxes on your own. You should implement systems now so that you can accurately track your income, your expenses, and deductions so that you are maximizing your returns. All right. So when you're looking for a tax preparer for your business, you should ask them the following questions. The first one is, are they qualified? All tax preparers should have an IRS PTIN number. That stands for Preparer Tax Identification Number. Paid tax preparers are required to register with the IRS. So be sure to ask for this in advance, as they are not allowed to prepare your tax returns without one. Now, you can use the IRS directory to verify your preparer's PTIN credentials. And the next question is, did they receive training? Ask if your tax preparer has any professional credentials. Enrolled agents, those are licensed by the IRS, certified public accountants, or attorneys all work as tax preparers. Other qualified preparers may be participants in what we call the annual filing season program. They may be bookkeepers or certified financial planners. But you can search for qualified tax preparers in your area on the IRS directory of federal tax return preparers. The next question is, have they worked with childcare businesses before, or do they understand your specific needs? Like I referenced earlier, experience counts when you're looking for qualified tax preparation services. So in addition to checking for the length of previous experience, you want to make sure that your tax preparation service has knowledge that is relevant to your specific circumstances. So ask them if they are also part of any professional organizations or take any continuing education courses so that they can stay up to date, and make sure that they know your state and local requirements in addition to those federal return requirements. Another question is, are they available after tax season for advice or changes? Oftentimes, we will have those companies that will only be available during tax season. And then if you happen to have a question, they're going to be very difficult to get a hold of. So you want to make sure that these are individuals, or make sure that you know whether or not you can access these individuals throughout the year, or if they are only going to be available during tax season. Another question you should ask is if you can get a copy of your returns. You want to make sure that you have all your hard copies of your filed tax returns and all documents, including your filings. Aside from the fact that it's a good idea to have a copy of your record or for your records, you never know when you might need a copy very quickly. While several of these online tax programs are going to have that capability of allowing you to log in at any time and print or download a copy of your returns, tax preparers may or may not be as easily accessible outside of tax season. So in addition to those hard copies of all your documents in your tax returns, we do recommend that you have electronic copies as well. Again, your digital copies could be something as simple as converting them to PDFs or even taking pictures of them on your phone. There are lots of apps that can help you to capture these documents. And then finally, just make sure that all your original documents that you submitted to your tax preparer are returned to you. And keep all your receipts, proof of payments, your 1099s, and all other tax-related documents. And you want to keep those for at least 4 years. Now, if you want to complete your taxes on your own, there are several online tax guides that are available for you to use as you choose to do so. So these guides are designed specifically for childcare providers who want to use maybe online tax software. We do have guides available for TurboTax, for H&R Block, and for TaxAct, along with some buyer's guides to help you to choose the software that best suits your needs. We did drop a link in the chat for the TurboTax Self-Employed Online Tax Preparation Guide. We also have included a link with all of the guides that will help you to understand grant funding, taxes, managing your business finances, business operations, things to that effect. So these are tools that are free. They're easy to use, and they do include screenshots for better ease of use. Now, here is another really great resource, the Confidence and Quality Tax Rubric app. This was developed based on actual family and center childcare providers' tax returns. And it's basically designed to help providers and their tax preparers understand the specifics and the tax regulations for childcare providers. Now, the rubric is designed for sole proprietors and LLCs that are single members. That is, they report their income and expenses on that Schedule C through Form 1040, like we talked about in the very beginning. But providers who have S corporations, C corporations, partnerships, or LLCs that are declared as S or C corporations, they can still benefit from using this app, but the expense lines will look a little bit different. Now, this app is absolutely free. It's very easy to use. We highly encourage you to test out the rubric for yourself, see how it works and how it can be a benefit for your business. Carlos has dropped that link for you in the chat. We also have the proactive tax planning tool that will and can be particularly helpful prior to the year end. So we do recommend you checking both of those out as well.
Marlene, we have 6 minutes.
Yes, and we have actually reached this section where we are going to open up to questions. So I do want to say that it is vital to reflect on the insight that is acquired about accurately reporting your revenue and deductions for tax purposes. The next critical step is going to be to collect your financial data for the current year and facilitate a connection with the most suitable preparer that is available if you choose to do it outside of yourself. Now, whether you decide to tackle these taxes on your own or enlist the help of a qualified professional, it is important to take advantage of the rubric that we just dropped the link for. This tool is very instrumental in maximizing your deduction and minimizing your risk, and we strongly encourage you to utilize the tax prep guide that we have provided through Playground as well. So please note that the review on tax situation using this information contained in this presentation is not suitable for carefully selecting a qualified tax preparer, and it should not be used in place of legal accounting advice when needed. So we encourage you to seek out legal help whenever necessary. Now, we're going to open it up to questions.
Arlene, I can, oh,
Go
you-
ahead, Cindy.
okay, we have a question in the chat. What if you received the renovation grant for the childcare area windows, HVAC, flooring, the child carrier, can this be 100% expense for the home? So
So
sorry, go ahead.
in terms of specific grants, Cindy, I was actually going to defer that to you guys if you had more information on those grants.
And our go-to is that we want you to talk to your tax accountant. Because the same like Civitas, we're not allowed to give tax advice. So we're gonna encourage you to visit your tax professional for that.
Thank you, Cindy.
Thank you. And I'm going to move to the questions that are in our Q&A box. The first one I have asks, can I switch from miles and car expenses from year to year?
Typically, I know that there's one that if you start off with one, you're typically going to have to stick with that. What I would encourage you to do is, because I don't want to give you misinformation tonight, because I'm not sure which one is which off the top of my head, but I will say that there is our Tom Copeland blog, and I've left the QR code on the screen as well as the URL that I'm sure Carlos has or will drop in the chat for you all. You can pose those questions there to get an answer, and 9 times out of 10, the answer is probably somewhere in those resources that we have as well, because there are many, many questions that have been asked. 100% sure that's one of the questions. I just do not have that specific information off the top of my head tonight, so I apologize for that. But we do have the availability to go in there and look that information up. But the answer in its short form is you can switch, but if you start with one or the other, you're going to need to make sure that you know which one doesn't allow you to switch back.
Thank you, Marlene. I know we
Mhm.
have just a couple more minutes, so I'm going to try to get to as many questions as we can. The next one is, are construction materials and labor considered expenses that can be deducted?
Construction materials and labor. So I would need a little bit more context behind the question. Are they building onto their home, or is this something that they're getting through a grant?
I'm assuming it will be something that's building onto the home, but if Michael can add more information, that would be great. For now, I'll move on to the next question. It says, I received a grant this year to be spent and recorded the expenses in 2 years. Am I supposed to receive a 1099 for the grant? And do I need to pay taxes for the whole amount of the grant?
That's really going to depend on when you spend the money. You should get it. Yes, a 1099 should usually come with the grants. But remember the scenarios that we presented earlier where we had 3 different cases. You got the money in 2024, you spent the money in 2024. Then, that is that scenario, which is pretty easy peasy. Whereas sometimes you may get the money in a previous or get the money in a certain year, but spend the money in a different year. So it's really going to depend on the specifics behind when the money was received and when the money was spent.
Thank you so much. I am going to ask one more. For those who have assistance helpers, do they need to be provided with a W-2 or 1099?
Great question. So we do have a resource on our website that tells you the difference between understanding a contractual worker versus a W-2 employee. Sometimes it's difficult to understand the difference between the two, but we do have, I believe we also have an app, if I'm not mistaken, Carlos, but we do have a resource that can help providers to understand the difference between the two. So you're going to have to kind of run yourself through a series of questions to determine if that employee actually should be classified as a 1099 or if they are a W-2 employee. There are a lot of different questions that you would run through. So I can't just say yes or no either way, because there are so many elements involved in making sure that you understand that determination. So I would encourage you to go to our website. Thank you, Carlos, for dropping that. He put it in the chat, contractor versus employee app. And so just run through that and try to see if the scenario makes sense to pay them as a 1099 versus a W-2 employee, or vice versa.
Thank you so much, Marlene. We are at time. I want to thank all the participants for attending. I know this is a lot of information and there are questions that we weren't able to get to. I'm going to encourage everybody to please visit tomcopelandblog.com. We have Civitas Strategies staff members who will be reviewing those questions. And if you specify that you attended the LIIF webinar, they will work on getting to those questions and uploading the answers to their YouTube channel. So please, we highly encourage you to ask as many questions as you have at the tomcopelandblog.com for them to get answered. And I'm going to pass it to Cindy for closing.
Thank you, Leslie. Thank you, everyone, for coming out of your programs this rainy evening of your where it's raining. So thank you so much. I'm hoping everybody has a great rest of your evening. Thank you, Civitas, for doing such great training, such great information. Marlene and the translators, you guys are awesome. So thank you so much and have a good night.
Thank you, and thanks for having us.
Thank you so much, Marlene, Carlos, Magdalena, and Terry. We appreciate your services. Have a great evening.
All right, you as well. Bye-bye.